All right, so in the last video, we talked about moneyness, specifically the differences between in the money, at the money, and out of the money. Next, we need to consider intrinsic versus extrinsic value. Now, when you buy an option, you're paying a fee to the option seller, and that fee is the option premium. Option pricing is always made up of some amount of extrinsic value and sometimes even intrinsic value. Now, intrinsic value is the value any given option would have if it were exercised today. Let's take Apple for example. Let's say today it trades at $168 and you bought a $150 Apple call. Well, the intrinsic value is $18, or the difference between the equity value and the strike price. And all in the money options have intrinsic value, the difference between the current stock price and the strike price, or how much in the money the option actually is. And that means it's worth something. But in the money options will also have, to some extent, extrinsic value. Extrinsic value is the amount of money over and above the intrinsic value that you have to pay for buying an option. So, taking from the Apple option or the Apple example before, if it trades at $168 and you bought a $150 call option strike, well, there's $18 of intrinsic value, but that's not going to be the premium. The premium could be $20 for the option, and if that were the case, then you'd have $2 of extrinsic value. And we calculate that by subtracting the option premium minus the intrinsic value. And as a call option buyer, here's the secret, you want to pay as little extrinsic value as possible. Now, you might be wondering if at the money or out of the money options are worth something. Well, options that are at the money or out of the money, they have no intrinsic value. Zip, nothing. It's basically a hope and a dream, a lottery ticket. And that's why so many option traders lose money. They buy options with little to no intrinsic value.